Let's talk a little bit about this volatility we've seen in the oil price. I've got this chart here, shows that oil is 4 times more volatile than stocks since around the autumn of last year. Not sure if that tells us more about oil volatility or a lack of volatility in the stock market, but certainly as we're looking at this gradually reflationary environment globally, it's still crucial, isn't it, where the oil price heads from here, and we don't seem to have stability yet, do we?
We don't seem to, although we did make I tend to think in longer terms, and we made a move about a year ago from $30, which seemed ridiculously cheap, up to the $50 mark. And we've always believed that around the $50 mark, you have quite a lot of flexible supply, with US fracking and so on. So our perspective was it was probably capped around the $50 mark. And the slight reduction in US reserves is probably matched by the fact that Chinese reserves seem to be quite elevated at the minute. So the Chinese have been buying a lot of oil. The US looks like it's using its oil up slightly. And Saudi Arabia seems quite happy to be the swing supplier still. So our view is maybe day-to-day volatility is reasonably elevated, but it's still dodging around that $50 mark.
All right, Manus, come in here.
Yes, a very good day to you, Euan. Let's talk about oil, because one of the biggest drivers in this reflationary story, apart from Trump, has been oil. I suppose when you see it really finding it difficult to stay any higher than $50. My question to you is the global reflation trade, of which oil is a part of, is that beginning to peter out? I'm trying to tie a couple of strands together there. Help me out.
Yes, I mean, it's quite interesting. Immediately after Donald Trump's election, a number of different factors, if you're looking for markers of the reflation trade, you would expect to see the equity market going up, certainly. You'd expect to see inflation break-evens going up. You'd expect interest rate curves to steepen. And perhaps you would expect commodities like oil to go up as well. And immediately after he was elected, that did happen. And then through January, February, the only real marker of the reflation trade was that the equity market was going up, and a lot of the other things went into reverse until the last few weeks, where we've seen again rises in real interest rates, and we've seen inflation expectations going up. So I think there's a broader set of markers that say the market is starting to once again revisit the broader-based reflation trade, and we think it's correct to do so.
So if we've got this reflation trade very much present then, and I pulled up this chart which shows the balance sheets of the biggest central banks in the world. This, of course, the Fed topping out on its balance sheet, but the balance sheets of the ECB and the BOJ still growing. They will have to revisit that then. They will have to revisit their monetary policy if that is the case.
They will indeed, and it's going to be quite interesting to see. I mean, obviously, there's been a huge amount of political uncertainty over the last few years, really, and it's been balanced by super accommodative monetary policy. And clearly, today we'll probably see the Fed putting up interest rates. But the question marks are then going to be raised in other central banks. To what extent do they mirror that?
And how much can they be left behind?
Yeah, and I don't think it's going to be seen in interest rate rises, but it will be seen in tapering of the QE programme.
Euan, I want to show you this chart. Can they both be right? Robert Shiller, the Nobel laureate yesterday, he talked about back in the 2000s, whenever there was the new era of tech. Do you remember Greenspan talked about the paradigm shift? Well, here we are, the new era. He talks about a new leader being born. He's rather skeptical. VIX is dropping, markets are rising. Do you share Shiller's skepticism in terms of, is this a touch of the emperor's new clothes, or am I just being rather Grinch-like because I'm cold?
Well, maybe you are a bit cold there in Amsterdam, but I think the truth is that I think last time I was here, I did talk about the prospect or the possibility of a melt-up in risk assets. That there was definitely going to be an increase in interest rates and a removal of monetary policy, but the pace was going to be slower than perhaps it ought to be if you're really trying to keep a lid on inflation. And so while interest rates will rise, we're still in an environment where real interest rates are negative. That is super accommodative. and unless interest rates go up materially, much more than is priced into interest rate forwards, it's not really going to undermine equity valuations. So in an environment where you still have 10-year bond yields in Germany at sub 0.5%, so 0.4 or so in Germany, the dividend income from equities, if you don't believe that dividends are going to be cut because growth is going to be enough just to sustain the current level of dividends, the valuation of equity should be quite high in that context.